This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Let's make a deal. The Justice Department clears a cable mega merger. One newspaper company takes public its bid for another. But is deal making the answer to overcome media industry challenges?
Fast Lane, why the next big battle in the world's largest auto market will be over the biggest vehicles on the road.
The business of pain, the alarming numbers that describe prescription drug abuse in America, the first of a three-part series tonight on Nightly Business Report for Monday, April 25th.
Good evening, everyone, and welcome. The media industry, undergoing tremendous change, today is undergoing even more. We begin with a cable deal. Charter Communications won antitrust approval for its $55 billion takeover of Time Warner Cable. That combination would create the second largest cable provider in the country. The head of the Federal Communications Commission also reportedly supports the merger, but there are conditions attached, all of which aim to increase the number of homes with high-speed internet and mitigate threats to online video competition. Charter would have to build out broadband service to 2 million more homes. The combined company would have to move away from data caps and usage-based billing, and it cannot charge a fee to heavy traffic providers like Netflix. Shares of both Charter and Time Warner Cable rose more than 4% in today's trading.
And that, Sue, is not the only deal in the media industry to tell you about. Gannett wants to buy the rival newspaper owner Tribune Publishing. But when its private offers were rebuffed by Tribune, Gannett went public. And that sent shares of Tribune up nearly 53% in today's trading alone. Gannett higher by about 6.5%. And as Julia Borston reports, in the struggling newspaper business, Gannett's offer may be one Tribune just can't refuse.
It's a proposed merger of old media giants, USA Today parent Gannett offering $815 million, including the assumption of debt, to buy the Tribune Company, owner of the LA Times, Chicago Tribune, and Baltimore Sun, a total of 11 daily titles and more than 60 digital properties. The offer, a more than 60% premium to Tribune's closing price Friday, sending shares skyrocketing, though over the past year it had been down 60%.
That scale and that cost consolidation on every level is the only way to make it through what is a deep winter chill in the newspaper industry that's just getting colder.
Industry analyst Ken Doctor is talking about the massive challenges facing all newspapers, declines in advertising and subscription revenue, plus more competition than ever from a host of digital alternatives. Gannett's already been consolidating. Less than a month ago, it completed its $280 million acquisition of Journal Media Group. Gannett has 127 local media organizations stateside and 160 brands in the UK. But even more consolidation gives its papers a better chance at survival. Still, it may not be able to negotiate much better deals with the internet giants who profit from the traffic that news articles drive.
Content and news content changing all the time brings in audience. It's a great thing. It brings in audience. Yet the people controlling the money making, the monetization, are the pipes companies. So it's Facebook and Google that are taking in most of the money.
And the trend for newspapers isn't good. Mobile internet advertising is poised to overtake newspaper advertising this year, making mobile internet the third largest ad medium worldwide, behind television and internet ads, putting more pressure on Gannett to gain power from its scale. For Nightly Business Report, I'm Julia Borston in Los Angeles.
On Wall Street, it was the quiet before the storm. That's how some describe today's action as investors prepare for the busiest week of earnings this season and a meeting of the Federal Reserve policymakers. By the close, the Dow Jones Industrial Average fell 26 points to 17,977. The Nasdaq dropped 10. The S&P 500 was off more than 3. Bob Pisani has more on why today's quiet could fade quickly.
This is the big week for earnings. Almost a third of the S&P 500 reports, everything from drug companies like Pfizer and Merck to auto companies like Ford. But the two companies I most want to hear from are oil giants ExxonMobil and Chevron. They report later in the week. Investors want to hear first reassurances that the dividends are safe, and second, what's the outlook for oil prices and oil demand in the second half of the year? These stocks have staged impressive recoveries recently on expectations that global demand is again growing. There's also a Fed meeting on Wednesday, and while no one is expecting them to raise rates, traders will be watching to see if the statement leans towards highlighting the strengths in the economy rather than the weaknesses, which might indicate whether they will raise rates at the next meeting in June. Meantime, tech stocks have had a tough time on disappointing earnings, but other sectors have stepped in to fill the gap. So energy and healthcare and materials and financials, they're up 4 to 6% this month, while big technology names like Microsoft and Intel are all down. That rotation out of tech and into energy, materials, and financials is considered healthy by investors. The issue is whether earnings and the Fed commentary will allow us to push to new highs. You know, we're only 2% away. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Saudi Arabia wants to break its economic reliance on oil. Yes, you heard me right. The world's top oil exporter outlined an ambitious plan to remake and diversify its economy. Hadley Gamble reports tonight from Riyadh.
Well, total survival without oil, that is the goal. That's according to the Deputy Crown Prince of Saudi Arabia, Mohammed bin Salman, the son of the king. Earlier today, we heard further details of the National Transformation Strategy. That's the plan to diversify this country away from oil revenues, and he's basing this plan on about $30 per barrel. He says he doesn't expect the price of oil to go much lower than that. He's also announced plans for the Sovereign Wealth Fund that he says will be larger than any other in the world, between $2 and $3 trillion. He's also said that Saudi Aramco, that IPO, will be between 4 and 5% of the company, and he's valuing that between $2.5 and $3 trillion or even more. Now, we also understand that there are further plans in terms of trying to diversify away from oil revenues, one of which, of course, is the defense sector. Right now, this is a country that is the third largest importer of defense sector equipment in the world, and what they want to do is make sure that at least half of that going forward is locally purchased. Also, we heard a little bit more about the taxation plans. We've talked about the value-added tax that they're planning. We've talked about taxes on land as well. But one thing we didn't hear, lots of speculation over the last several days about whether or not women in this country are going to be allowed to drive. We know that the Saudi workforce is going to have to include more women coming in the future, but unfortunately no word on whether or not they'll be allowed to take the wheel in the kingdom anytime soon. For Nightly Business Report in Riyadh, I'm Hadley Gamble.
Oil exporting countries in the Middle East lost nearly $400 billion in revenue last year because of the low price of oil. According to the International Monetary Fund, those countries should brace for even deeper losses this year, possibly reaching $500 billion. The fund also said it's encouraged by the changes that Saudi Arabia is making to its economy.
China, already the world's largest auto market, has now become the #1 country for SUV sales. That demand has helped the bottom line of General Motors, Ford, and other automakers in that country. But now that success is being challenged. Phil LeBeau has more from the Beijing Auto Show.
Walk around the Beijing Auto Show, and it's clear China has fallen in love with SUVs. Last year, Chinese consumers bought more than 6 million of them, and sales remain red hot.
You're only going to see it accelerate, and frankly, Phil, around the world, you're seeing a lot of the D&E car stuff, suffer a little bit and either flatten out or decline. And it's true here too. The SUV market seems to be insatiable. So, we're going to be prepared to do that, and we just don't see anything slowing down on the SUV side of it.
But for all the success GM and Ford have had selling SUVs here in China, they're struggling to compete with Chinese brand SUVs like this one. It's the Changan CS35. Starts at about $10,000, well below the price point for SUVs made by international competitors.
When you look at what's driving SUV sales, it's the low end of the market. SUVs around $10,000 made by local automakers. That's the heart of the market right now.
Chinese automakers now sell more SUVs in this country than foreign brands. Their success with entry-level SUVs is why Jeep has started building its smallest model, the Renegade, here in China. Meanwhile, GM is rolling out the new Cadillac XT5 as it continues to flex its strength in luxury SUVs.
We're going to differentiate ourselves on quality and connectivity and reliability and durability, and we'll be competitive in the price part of it too.
China's auto market, where the next big battle is over the biggest vehicles on the road. Phil LeBeau, Nightly Business Report, Beijing.
Still ahead, your home is likely your biggest asset, but is a shift underway in the housing market? What the latest data may be signaling. Americans did not buy as many new homes in March. According to the Commerce Department, sales fell 1.5%, making this the third straight month of declines. Much of that drop came from the West, one of the nation's priciest housing markets, which saw sales plummet nearly 24%. Diana Olick joins us now. And Diana, good to have you here as always. Sales of new homes are falling. The supply of existing homes for sale is falling to new lows. Why the weakness?
Well, it's as you said, Sue, we're talking about price. You saw it in the West, which is the priciest markets. We'd seen the most activity in newly built homes on the high end over the last couple of years, but that part of the market is starting to soften, and the demand is really on the low end, on that entry-level buyer. Unfortunately, the builders don't tend to build for that buyer, but we did see a jump in the March numbers in newly built homes priced between $200,000 and $300,000. They jumped to their highest level since 2007. So, Tyler, that's really where the demand is. The question is, will builders put in that supply?
So why don't they want to build if the demand is there?
Well, unfortunately, it's all about the margins, right? We talk about that all the time. It costs a lot of money to put up a new home, and in fact, those costs are increasing for the land, for the labor, for the materials, and for a home builder, they're just not able to make the kind of profit they want on those lower-priced homes.
You're always talking to us about supply, and the supply of new homes bumped up a bit. Is that a good sign if you're in the market to buy a home?
It absolutely was a good sign that we did see supply jump to a 5.8-month supply. That's far higher than we have on existing homes. Right now, we have a very stark shortage of supply on the existing side. To see that supply move up on new homes is better because it means that the builders are going to have to soften up a little bit on the prices. But again, it's where is the price point of that house? I mean, you look at what they're building now, these are $2 million homes right here, and that's the vast majority of what we're seeing. We need to see that entry-level $100,000, $200,000 home. And only one of the big builders, D.R. Horton, has a brand, its Express brand, that really centers on that entry-level market. We need to see more of that.
All right, on that note, Diana, thank you as always. Diana Olick in Washington.
A new study on CEO pay shows that top executives at the nation's largest companies got a raise last year, albeit a modest one, and this comes despite lower revenue. Mary Thompson has more on the big bosses making the big bucks.
At the top of the corporate ladder, a pay increase for CEOs despite a volatile year in the markets.
I was wondering if we would see some drop year over year, and we didn't. We saw it rise again 3%.
Share price performance, one of the many metrics considered in determining executive pay, but a critical one, as boards work to align CEO pay with shareholder interests. For the 100 largest companies by revenue filing their proxies by April 1st, the median total return was 2% in 2015, while median CEO pay rose 3% to $14.5 million. As Dan Marsek of the compensation research firm Equilar tells us, this extends a trend in place since 2009.
Since then, we've seen CEO pay rise every single year. You would expect to see a rebound the following year when the market started to turn around a little bit. But in each successive year, we have seen it rise again.
The final list of the top 100 is still a work in progress, as other firms are still filing proxies. But on the first pass, familiar names land at the top. The highest paid CEOs, Oracle's co-CEOs Mark Hurd and Safra Catz, pulling down $53 million. They're followed by Disney's Bob Iger and Honeywell's David Cote. Missing from the list is Viacom CEO Philippe Doman, who was paid over $54 million. He didn't make the cut because Viacom's revenue wasn't enough to put it in the top 100. CEOs who took home even more as their shareholders lost ground include those at Alcoa, Emerson, and Whirlpool, while Starbucks CEO Howard Schultz took a 6% pay cut, even as the coffee chain's total return rose over 50%. And as he usually does in these surveys, Berkshire's Warren Buffett was last on the list. His pay under $500,000, small change for a billionaire. For Nightly Business Report, I'm Mary Thompson.
Xerox saw its profit fall 85% this past quarter, and that's where we begin tonight's market focus. The cost of breaking the company into two was a big drag on earnings, along with a decline in printer and copier sales. The company also cited foreign currency headwinds. Shares of the company fell sharply, down more than 13% to $9.68. Valiant Pharmaceuticals has a new CEO. Joseph Papa, who until recently served as CEO of Perrigo, a company known mostly for selling over-the-counter drugs, is shifting over to Valeant after helming Perrigo for over a decade. Valeant shares were initially higher, but then slipped to close at $35.16. Shares of Perrigo fell more than 18% to $99.40. Private equity firm KKR reported a loss of more than $300 million last quarter. This is the firm's biggest investment. First Data Corp continues to struggle. KKR bought First Data back in 2007 and maintained a large stake in the company after bringing it public last year. Shares fell about 3% to $14.49. And restaurant operator Bob Evans Farms says it is planning to close 27 locations and lay off 1,100 workers in a move designed to increase profitability. The company does say it hopes to relocate as many of its employees as possible and said it expects to take a charge of up to $8 million related to the restaurant closings. Shares of the company down just a fraction for the day to $46.95.
Halliburton will delay the release of its first quarter earnings until May 3rd as it nears its April 30th deadline to get approvals to complete its merger with Baker Hughes. Separately, the company, Halliburton, said it did lay off 6,000 workers in the past quarter. Shares of the oil services company dropped nearly 2% to $40.04. A big buyback to tell you about at Honeywell. The company says it intends to buy back up to $5 billion worth of shares. That's on top of $1 billion previously announced. Shares of Honeywell off slightly at $113.25. Shares of the Container Store rallied initially in after-hours trading on a solid full-year earnings outlook. The small-cap stock also reported a surprise increase in same-store sales. Retailer now focusing on cost cutting, announcing a company-wide salary freeze and a 401k match freeze. The stock, however, did pop initially in after-hours trading. It closed the regular session at $5.83.
A number of strategists are citing the presidential election as a wild card for the stock market, in part because markets don't like uncertainty. And as you know, this election cycle has been anything but predictable. Over the weekend, GOP candidates Ted Cruz and rival John Kasich decided to form an alliance to take on Donald Trump, something Trump calls collusion. And that's not all. One of the biggest financial donors in the Republican Party had somewhat kind words for Democratic frontrunner Hillary Clinton. John Harwood is in the center of it all. He's here to discuss the twists and turns on the campaign trail. John, good to see you as always. This alliance between Cruz and Kasich of late, what do you realistically think they will be able to achieve?
Not much, Sue. Voters tend not to take instruction on how they're going to cast ballots. So the idea that Ted Cruz and John Kasich are going to tell their supporters in these states, will you go vote for this guy rather than me? I'm not sure that that works. It's a practical move on their part, though, because they're running out of time to try to stop Donald Trump. He's on a path where he can get to 1237. It's not going to be easy. That's the number of delegates he needs to be nominated. But they're looking to do anything they can to take a couple of delegates here or there, try to prevent that and get to an open convention.
Does this in any way, I'm going to get a little out of order here, John, does this in any way confirm Trump's charges that the system is rigged against him, number one, and number two, mightn't that energize his backers who say, see, he was right?
Well, I would say no and yes. It will energize his backers. Does it prove the system is rigged? No. It's a strategic choice made by these other candidates, playing by the rules that all candidates can follow. It's like these other allegations that Trump has made about delegate fights. You know, when he is losing on some grounds, if in a scrap for delegates, he'll say, well, it's rigged against me. When he's winning, he doesn't say that. No, this is a tactic by Cruz and Kasich that is perfectly fine as a strategic choice. I just don't think it's likely to produce very much. And like you say, it is going to produce a counter-mobilization on the Trump side.
It is odd, is it not, to hear one of the deep-pocketed Koch brothers say that a possible Clinton presidency might not be that bad?
Yes, although I have to say, Sue, I think that is more an expression of discontent with the Republican field than anything positive about Hillary Clinton. In both cases, he said their rhetoric is going to have to be a lot different from their actions, or their actions will have to be a lot different from their rhetoric. I don't think anybody should hold their breath waiting for Charles Koch to embrace Hillary Clinton or put money behind her campaign.
All right, John, we'll leave it at there. Thank you very much. John Harwood in Washington.
And coming up, highly effective, hugely addictive, the business of pain medications. Tonight we begin the first of a three-part series.
Here's a look at what to watch tomorrow. Dow Components, Apple, 3M, and Procter & Gamble report earnings. The Federal Reserve begins its two-day policy meeting. Consumer confidence, durable goods, and the S&P Case-Shiller Home Price Index are due out, and that's what to watch for tomorrow.
As hospitals move to digitize records, they face a new threat: hackers. Recent attacks have forced some medical centers to pay ransom to regain access to their systems. While ransomware isn't new, these attacks highlight hospital vulnerabilities. As Bertha Coombs reports from Boston, changes, however, are being made to prevent the next breach.
Doctors and nurses at Cambridge Health Alliance have a tough balancing act when it comes to technology.
With the electronic medical record, it's made things more difficult to interact with the patient.
And on top of that, you add security.
Right, exactly. So you have the patient interaction, you have the computer, you have security, and you're trying to actually think clinically about what to do next.
By law, they have to protect patient information. Recent ransomware attacks that hobbled systems at Hollywood Presbyterian, MedStar Health, and other hospitals have made them more aware that they could be targeted. One way to make it easier for staff to keep the system safe is to get away from passwords, says security firm Imprivata co-founder David Ting.
Whether it's using your fingerprint, taking your card and swiping it, eliminating those additional things that you have to mentally think about, like, gee, what password did I use for this application? And that habit of, and that trend to say, let me use the same password across all applications.
At Cambridge Health, they also try to make thinking about safety a habit. Testing staff,
they get an email that looks similar to this,
with phishing emails to teach them to be alert for malware. And now they put management to the test with surprise breach drills.
We have an outside facilitator that comes in and said, here's your scenario, now go down through it, utilizing your policy, your procedures, and everything else. So it's a whole team that comes together that's already organized and already has a set process that we practice and test each year.
According to an IBM study, in the U.S., healthcare became the most targeted industry for hackers in 2015. But cybersecurity analysts say hospitals aren't the only ones who should be practicing and assessing their risk.
We typically hear just about healthcare providers or hospitals because they have really strict regulatory requirements that require they report these incidents. Other industries and other organizations don't have these same regulations.
Cambridge Health's Chief Information Security Officer says the surprise breach drills have been invaluable to help teach the staff how to respond quickly and effectively in the increasingly likely event of a breach of the hospital's system. For Nightly Business Report, I'm Bertha Coombs in Boston.
A Food and Drug Administration panel is meeting to discuss Sarepta's muscular dystrophy drug, which we reported on late last year. Patients and advocates are trying to persuade advisors to support approval of an experimental drug for the disease. Last week, the FDA reiterated a negative earlier assessment of the drug, which questioned the clinical trials.
Today's pain medications are highly effective. Many are also hugely addictive. Sales are high and rising. So are overdose deaths from prescription pain relievers, now exceeding 20,000 a year. Dina Gosofsky has the first part of our series, The Business of Pain.
It's killing the country. It's taken kids as young as 13. It's taken people that are 65 and 70 years old. They're getting addicted. They have no idea how to stop.
Recovering addict Bobby Long is one of the faces behind a shocking statistic. About 80% of all opioid medications, the most addictive of painkillers, is consumed by Americans.
Opioid prescriptions have skyrocketed, and we have currently nearly 250 million prescriptions for opioids written every year. That's enough for every adult in America to have a bottle of pills and then some.
And those opioids are part of a $24 billion prescription painkiller market. The top 5 opioid products based on 2015 sales were made by Purdue Pharma, Johnson & Johnson, Insys Therapeutics, Mylan, and Depamed. But new regulations in the pain market can impact sales. For instance, in 2014, when the DEA reclassified the painkiller hydrocodone because of its potential high risk of abuse from a Schedule III to a Schedule II drug, there was a 27% decline in sales from 2013 to 2015. So drugs like Vicodin, for example, can't be administered as easily as they were before. Patients now have to bring a physical prescription to a pharmacy in order to get it filled. It's yet to be seen if stricter guidelines will reduce the number of deaths caused by drug overdoses, which hit a record 28,000 in 2014.
We're just recognizing this is a huge problem. It affects all of us. When a problem is moving quickly, Congress is always going to be a little bit behind in catching up, but I think there's a very, very clear awareness now of just how serious this is.
For Nightly Business Report, I'm Dina Gosofsky.
Our series continues tomorrow with one man's struggle with addiction and the overall economic cost of the epidemic nationwide.
And that does it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we'll see you right back here tomorrow night.